Welcome to The Explainer. Let's talk about November 10th, 2025. The stock market? Well, it threw a massive party. But if you look just a little bit closer, you can see a huge crack forming right under the surface. So today, we're going to break down this great disconnect and figure out what it really means for investors. I mean, on the surface, everything looked fantastic. The market absolutely surged, with a tech-heavy Nasdaq just blasting ahead with a 2.3% gain. The S&P and the Dow were right there with it. But numbers like these, they don't tell the whole story, not even close. Because what we saw today was really a tale of two completely different economies. You've got Wall Street, just giddy with optimism because of some good news out of Washington, and then you've got Main Street, where new data shows the economic pain is actually getting worse. Okay, so let's dig into that. What exactly lit the fuse for today's rally? The biggest driver, by far, was a breakthrough in Washington. The news that a deal was reached to end the government shutdown sent this huge wave of relief through the market. It created what traders call a risk-on mood. That's basically everyone feeling confident enough to jump back into stocks. All those fears about a cash crunch just vanished.
And then you get this comment from Fed Chair Jerome Powell, which is really interesting. He's drawing a line in the sand, saying today's AI boom is built on real profits, not like the dot-com bubble. He basically gave a green light to tech investors, which just added more fuel to the fire.
And yet, here it is, the great disconnect in one single number. While Wall Street was popping champagne, this super important measure of how average people feel about their finances absolutely plummeted to a 3-year low. It's a booming market, completely detached from the real world, where consumers are seriously struggling.
Now, let's see how this whole disconnect played out in some individual stocks. A few key companies perfectly capture all the conflicting forces we saw today.
First up, we have to talk about the undisputed king of the AI world, NVIDIA. The stock was on an absolute tear, jumping nearly 6% in just one session. And this wasn't just hype. This was driven by some incredible real-world demand. News got out that the CEO asked for a massive 50% production boost. That just proves the appetite for AI chips is out of control. And of course, Wall Street loved it, with analysts at Citigroup jacking up their price target. Okay, next up, another big name in the AI and data space, Palantir. And this one surged even more, rallying an incredible 8.8%. Wow. For Palantir, this was all about the mood of the market. The stock had been held down because a lot of people thought it was just too expensive. But the second that shutdown uncertainty lifted, boom. Speculative buyers just rushed back in, totally overwhelming the doubters and betting big on its future. But yeah, it was not a good day for everybody. Not at all. On the complete other side of the coin, you have Oscar Health. The stock didn't just fall, it got absolutely crushed, plunging a massive 16%. So what happened here? Well, this was a direct hit from political risk. Investors are terrified that the details in that shutdown deal could threaten the Affordable Care Act subsidies, which are absolutely essential to Oscar's business. It's just a huge reminder of how vulnerable some companies are to what happens in Washington. And finally, let's look at the very curious case of Tesla. It posted a really solid gain, up nearly 4% on the day. And this stock just illustrates the theme of the day perfectly. Tesla rallied despite a bunch of bad news, a key executive leaving, a big reported drop in China sales, but none of it mattered. The broad risk-on mood for tech and AI was just so powerful that it was able to lift even the boats that had a few leaks. So with all of these conflicting signals, how are you supposed to think about this market? Let's walk through 3 potential playbooks based on everything we saw today. All right, so you've got a few options here. The aggressive path is basically going all in on AI. You believe it's a long-term revolution, and you're buying every dip. The risk? You could be buying right into a bubble. Then there's the neutral path. You stay in the game, but you keep some cash on the sidelines. You get some of the gains, but you're hedged. And finally, the defensive path. This is you bracing for a major correction. The risk here, of course, is that you could miss out on some huge gains if this AI boom just keeps on running. Which brings us to the final and most important takeaway from today. What does this all really mean when you put it together?
If we boil this entire day down, the single most positive thing is that the AI growth story is proving to be incredibly powerful. It's real. But
The most negative thing is that the market is built like a Jenga tower. It's structurally fragile because the whole rally is concentrated in just a few giant stocks, and it's completely disconnected from the consumer economy, which is really starting to show some cracks.
And that leaves us with the ultimate question, doesn't it? Are you investing in a skyscraper built on a solid foundation of innovation, or are you putting your money into a wobbly Jenga tower that could come crashing down with just one wrong move? Deciding which of those structures you truly believe in, well, that's the whole game right now.